And just watching what you've seen as a technical strategist, Jason, you are a little concerned that the S&P 500 can hold on to these gains. Why is that?
That's right. And what we've seen is this continued leadership from the growth groups, the NASDAQ that you had just mentioned. What we're more focused on is the market crossed what we think is a key bifurcation at the 2,800 to 3,000 area from a technical perspective, and a couple other metrics that we look at. Is what you saw was a brief period of rotation to cyclicals where you saw small caps, cyclicals versus defensives, that type of rotation. We think that's required to propel the market further. And even if you go back and look at recent periods where, over the last business cycle, when the manufacturing cycle has started to lift, those are the brief periods over that 10-year period that you actually saw that type of leadership.
What might be different about this time? I mean, we haven't experienced this in our lifetimes, to watch a pandemic like this play out and to watch the economic closures that have come as a result. And I know you're a technical analyst, but is there anything that you can map this up against?
Yeah, sure. I mean, in terms of what could be different, certainly the monetary policy, is something that could be different. And that's used as, potentially one of the reasons why the growth stocks continue to move up. You see continued contained yields. That's a rationalization behind why valuations don't matter so much now, that you can see that continued movement. But like I said, if you look back historically, at some point, that monetary policy has to translate into economic growth. And just going by the patterns that we saw in the last economic cycle, if manufacturing is going to start to show a sustained recovery, that's the periods that you see cyclicals move. Furthermore, if you look at just relative performances, you've already mentioned the strong year-to-date performance or move off the lows or year-over-year that we're seeing in those growth groups. You don't necessarily see that in the cyclically sensitive groups. And to the extent that there's fast money that simply has chased momentum, if the economic data proves to be a false dawn and equities come under pressure again, we suspect that fast money leaves those, groups that have already moved quite a bit more susceptible to at least a short-term period where they're going to see underperformance versus the value groups that haven't really participated to the same extent.
The concern about those big tech stocks that have been leading the way higher, I mean, that's been out there for a while. What makes you look at it and say, okay, this is now why I'm sounding the alarm. This is what I've seen. These are the levels that's crossed that really push this out of whack.
Well, I mean, if you look at from a technical point of view, if we look at a log chart of the NASDAQ 100, there's a very well-defined channel that's extended, really from, let's call it, not quite the 2009 low, but certainly since the European sovereign crisis periods of 2010 and 2011. The NASDAQ stalled there earlier this year when it made its former all-time high, and now it's right back up to that channel resistance. From a year-over-year growth perspective, just looking at that as a simple momentum metric, that also has moved to the upper end of the same range, and it's not surprising because they're pretty much one and the same. So that's kind of the way we're thinking about that. That group should start to at least get sticky up here. We're not expecting it to sell off in a continued rally, but there should be some sense of where you're going to get some value outperformance if the rally is to persist from here.